looks like we have everybody here. Again, Tony will be with us a bit late, but we'll get started. First, I want to thank everybody for attending the Place Your Trade Spaces covering Pac-Asia energy and commodities markets and how you can trade event contracts to trade natural gas and crude oil as well as metals. The Spaces is brought to you by TraderBait. It has a built-in custom web app dedicated to trading event contracts. You can use the link in my Twitter stream to go and get the TraderBait app for free. I also write a weekly blog for placeyourtrades.com on energy and metals that you can access for free. So I'll get right to it. Since there was no EIA today, I'll introduce our guests. We have Valina Chakarova, who Valina is an expert in the field of geopolitics with over 20 years of professional experience and academic background in the field of security and defense. She has a wealth of knowledge and experience in understanding and analyzing the geopolitical landscape and its impact on business and organizations. Before founding her company FACE, Valina served as the director of the Austrian Institute for European and Security Policy in Vienna, Austria. She continues to share her expertise as an instructor at the Real World Risk Institute under the direction of Nassim Taleb. We have Vandana Hari, who is the founder and CEO of Vanda Insights, the Singapore-based provider of global oil markets, macro analysis. She has 25 years experience providing intelligence on global energy markets to stakeholders in the petroleum industry, policymakers, and wealth managers. Before launching Vanda Insights in 2016, she served in a leadership position at S&P Global Platts. Her tenure at Platts included managing news reporting and price assessment, operations, research and analysis, business strategy and execution, and stakeholder engagement. She's a regular speaker at international energy conferences and is extensively quoted by business media around the world. We have Tarek Booker from Australia. In his career, Tarek has covered geopolitics, economics, and finance for some of the largest news organizations across 3 continents. In more recent years, he's built up quite the following as an independent analysis, with his work highly valued by a wide range of readers, from everyday investors all the way to individuals at the institutional level. And then we'll have Tony Nash again, who will be joining us later. Tony is the CEO and founder of Complete Intelligence. Complete Intelligence enables digitalization and automation, oh my God, I can't speak this morning, of enterprise and financial market forecasting with a globally integrated machine learning platform. Previously, Tony built and led the global research business for The Economist and the Asia consulting business for IHS, which is now part of the S&P. He's a frequent public speaker and contributor to leading global media platforms, including BBC, CNBC, and Bloomberg. He served as an advisor to government and think tanks in Tokyo, Singapore, Beijing, Washington, D.C., and others. He is also an international advisory board member for Texas A&M University. I want to start by saying thank you, Tarek and Vandana, for coming to us from Australia and Singapore. Thank you for staying up so late for this. I really, really appreciate it.
No worries. It's a pleasure to be here.
Well, thank you. I do appreciate it. So we're going to start with Valina. We're going to start with you to kind of a broad-based overview of the macro political landscape. And you've talked a lot in the past about the dragon bear, but I want to kind of throw India into this mix. So can you give us kind of a geopolitical constellation between India, China, Russia, and their growing commodity trade volumes?
Thank you very much, Tracy, for having me. It's a great pleasure to discuss these highly relevant topics with you and all the rest of the guests, some of whom I have been following on Twitter with great interest, some of whom I can also call friends. Meanwhile, now we are in a very unique geopolitical environment, given the ongoing war that Russia launched almost a year ago, and also given the global system shifts and the geopolitical developments in the Indo-Pacific region. I would start with a very short wrap-up by pointing on the one hand to long-lasting strategic partnership between Russia and India that actually is going back to the time of the Cold War. And if I would use just one sentence to not simplify, of course, this strategic partnership, but just to explain why India was quite neutral in the ongoing war, that would, of course, mean that it was backing more or less the Russian position, is to be wrapped up by the so to say, the interdependencies between these two countries, referring to the arms supply coming from Russia, over 50%, important sector of the fertilizers. India has to feed a growing population of 1.4 billion, as we know, and is the largest wheat producer, not the largest wheat exporter. We have to clarify that as well, but it needs, of course, the fertilizers, and a lot of them are coming from Moscow. And then again, of course, what India has been relying on is the perpetual, if you like, support in the UN Security Council. Now, when it comes to China, what I've been pointing to over the last 10 years is this emerging temporary asymmetric modus vivendi of coordination. So it's not a strategic alliance by any means. It's not any kind of, let's say, Western-like concept of strategic relationship between Moscow and Beijing. However, it has deepened to the point following the first invasion of Ukraine in 2014 that by 2022, Russia would have not launched a full-scale war on the second largest European country if it had not relied on the comprehensive support coming from Beijing. So, and that, as we saw from the last 11 months, was, of course, encompassing various dimensions, from diplomatic support, or let's say the dissemination of Russian narratives, to the coordination in various regions, to, of course, an immense trade volume. China is, meanwhile, the largest trading partner of Russia. So, to sum it up, of course, Russia is somehow in between, capitalizing on, of course, the military tensions between China and India. The last military tensions happened actually in 2022 along the line of actual control. The previous military clash was, took place in 2017. So both countries, India and China, the two Asian giants, are projected to be involved in further military escalations, which of course have limited scope and yet will be, of course, impacting the global system and the global environment when it comes to the interconnected socioeconomic networks. And if you take a look at Russia's positioning, it practically benefits from supplying both sides with arms, having this very long-term relationships, asymmetric ones, as India is projected to become world's economic power number 3 next to the United States and China. And yet it is a kind of a glue in various regional formats for both countries, for China and India to also communicate with each other, to have a kind of a dialogue. Think of the BRICS format, think also of the Shanghai Cooperation Organization. I will stop here and will be open for questions on your side.
Okay, but I mean, speaking of, I mean, how do you think? And we know that there's kind of India's alliance with Russia is somewhat of a counterbalance to India-China tensions. But do you think these military tensions between India and China are going to continue? And if so, does this affect the commodities trade, if any?
Yes, the military tensions between China and India will continue. So far, they will have a limited scope. That means that both countries have signed an agreement back in 1997 to actually not allow the use of military force in a direct military clash. And practically, their engagements along the line of actual control. This is their common border. They have various, weak spots along this common border on both sides. A lot of troops have been amassed. These are really critical environmental conditions. You would imagine that it's not really easy to have, let's say, a military conflict in this high altitude. So they practically are having these short-term military clashes where they are fighting with wooden sticks, literally, so that there is no, as I said, use of military power. But given the fact that India is projected to, India's economy is projected to further grow, and that means bullish on the commodity sides, because there will be in a dire need for more, let's say, practically a lot more of everything, if I can put it just in one sentence, from the use of energy, the buildup of infrastructure, all of the components of a growing economy will demand, of course, a lot more commodities. And we've observed already this trend during the last 11 months, specifically when Russia was sanctioned, that the volume of exports coming, specifically oil, coming from Russia to India has grown to more than 100%. That also means that commodities, and specifically minerals, rare earths, and so on, that are needed for green transition. India has announced the goal of full decarbonization by 2070, but it will be eager to build, for instance, in the field, to build up capacities in the field of green hydrogen. So once again, there will be a high demand, and then, of course, digitalization. On behalf of China, here, of course, the main topic is that China cannot afford itself to end up in a situation of what I call three fronts scenario. What does that mean? On the one hand, scaling up the military escalation in the Strait of Taiwan. On the other hand, preparing for further military tensions with India. And that means preparing accordingly, and then in eventual negative outcome for Moscow in its war against Ukraine, to also prepare for security vacuum in the north. Given the 4,200 kilometers long common border, that of course would mean that it will be eager to secure as much of the required commodities as possible. We've seen even prior to the war that China had started stockpiling a lot of them. And so in general, to wrap it up, given now the opening up of China, once again, China will do exactly what India is also doing, capitalizing on the weaknesses coming from the largest, or let's say one of the largest commodities exporters, being Russia, and trying to benefit from these weaknesses by increasing the share of commodities coming from Russia. Then again, of course, given the fact that the West has sanctioned Russia, Russia is currently the most sanctioned country in the world, they will have less options. And that is not necessarily good news for global markets, because they will have, specifically the Europeans are here on the losing side, because we are very much energy dependent, and we'll have to look for other options to get the required oil gas and coal, given the really, really high dependence that has been the case before the war began.
Excellent. Thank you very much. I'm going to move it over to Vandana. I'd like to kind of walk us kind of through some of your more macro-based views for 2023 for energy specifically and energy security within the region. So China, India, South Korea, etc.
Hi, Tracy. Thank you. And greetings to all our listeners from Singapore. So just picking up from Velina's points, I think she talked about the military conflict and tensions between India and China. I see quite a bit of tensions and competition spilling over into the commercial space as well. So again, just to put that in context, China and India are the second and third largest consumers of oil globally, next, obviously, after the United States, which is the largest consumer. To some extent, through 2022, as Chinese economy suffered a setback, India has gained in many ways. So, of course, Indian economy has been growing quite a bit on its own steam as well, but there have been areas where India has benefited from China taking a bit of a backseat, if you will. So, foreign investment is definitely one. So one of the concerns in India right now is that as China reopens, could some of those investors move, pull out of India and move into China? So that is one. In the field of energy, I think there's going to be definitely more direct competition. So we've been talking about China and India both buying more Russian crude. Now, we tend to talk in terms of commonalities, and we say Europe is taking less of Russian crude, and Asia is taking more, and we tend to club China and India together. And sometimes the nuance that goes missing in this is that, yes, China and India are both taking more Russian crude, but Chinese crude imports were actually down last year for the second year in a row, almost down 1% year on year. Contrast that with, they could have been growing 4, 5, 6% year on year. And to a large extent, India was a beneficiary of this. So if India is benefiting from getting Russian crude, let's say 20, 30% discount to Brent, part of that advantage might go away as China comes back into the market, which completely is expected to. As its economy recovers, industrial activity picks up, mobility picks up, Chinese oil demand is expected to rebound. Now, Chinese oil demand slumped by, we estimate, almost 500,000 barrels per day. That's quite a staggering number. The first ever annual drop in Chinese oil demand since 1990. But as it comes back up, and at the very least, I expect it to come back up by the 500,000 barrels per day that was lost last year, and potentially more. That means China and India, yes, Russia's crude export market has shrunk. The steep discounts will remain, but China will also be competing to a larger extent with India for that crude. So it will be an interesting dynamic to watch. And of course, to some extent, it will also play out in LNG markets. Just generally, as China comes back into the markets with its energy demand, a lot of the other countries in Asia, which are, shall we say, so Japan and Korea, I would put them in a separate bucket. They have the paying power, but there's a lot of other countries, Southeast Asia and South Asia, that cannot completely compete with China in terms of paying power. So they will suffer. And these economies are also import dependent. So I think that sort of rivalry, if you will be an interesting one to watch this year. just in a larger perspective, in terms of my macro views, I think I am. It's almost starting to sound like a cliche. People saying, "Will this be a year of two halves?" In terms of energy demand and energy prices as well. But I have to say, yes, probably will. I am a little more optimistic in terms of the return of Chinese demand post, once it gets out of this very painful transition that is undergoing after zero COVID. Probably I would start seeing, and we're already seeing some of that excitement in the markets today. I mean, look at how crude has rallied over the past 10 sessions or so. I expect Chinese demand to start coming back quite strongly in the second quarter. I think jet fuel demand, especially mobility, will be the first one to return. So, and then the second half of the year is when we see a more sustainable sort of Chinese demand, which will be, I guess, more dependent on how its manufacturing activity and mobility other than air travel and jet fuel picks up.
Well, okay, I'm going to ask you the $1 million question that everybody's talking about. Everybody wants to know how much demand do they think it's going to increase from China. And we've seen analysts, all over the board, from 800,000 barrels per day to I've seen it as upward as 3 or 4. So can you share with us what you feel that kind of demand is going to come back?
Yeah, sure, Tracy. I love $1 million questions. So I'm not in the uber bullish camp. I'm aware, as you mentioned, people might have predicted 2, 3, I might have even seen 2 million barrel per day year-on-year demand growth in China. As I mentioned earlier, my estimate is Chinese demand contracted by about 500,000 barrels per day last year. I expect that at the very least to come back before the end of this year. And I do believe that the actual momentum in Chinese demand growth. So if you say that just the 500 that was lost last year will come back this year, that doesn't actually mean the growth momentum is back. So that momentum I expect will spill over into 2024. But at the very least, I would expect it to grow by 500-600. It could be up to 700,000 barrels per day within this year. But then it's obviously we tend to see it sometimes in blocks of like calendar years, but it's going to spill over into 2024 for sure.
Fantastic, thank you. So I'm gonna head over to Tarek right now. So I kind of wanted to see. What's your outlook on China reopening, on the reopening story for commodities? But also, I wanted to talk about, over the last couple of years, we've seen some trade tiffs, obviously, between Australia and China over commodities. There's recent talk of them lifting the coal ban. Is this significant or not? And do you think this will, lead to more, to kind of a lessening tiff between these two over commodities?
Well, first off, thanks for having me. It's great to be part of such an illustrious panel here. I'll start with the last question first in a little bit of a twist, but I think that what we're seeing in terms of the normalization of relations between Canberra and Beijing is really just it's partially driven by the desire to normalize the supply of commodities heading into China, to remove those market distortions that really got created with the coal ban, which was actually, ironically enough, one of the drivers that sent coal prices, particularly thermal coal prices, so high since it was enacted. But I think it's just part of the current push for the friendlier, nicer, more amenable China. And I think that will likely continue, because that is currently the sort of agenda that's on that Beijing is pushing. But as to whether or not it's going to be sustained in the long term may end up being a bit of another question, and I'd probably be quite cautious. as to whether or not we'll end up lasting. And as for the issue of the Chinese reopening, I think Vandana made a really good point that there is a great deal of complexity in terms of how it all plays out and how the timeline plays out. Because we are seeing, say for example, it was recently reported that there are more flights in China now than at any other time since the pandemic began, and there are more flights in China now than this time before the pandemic began. So we are seeing that strong upsurge in Chinese oil demand from flights and from aviation. But in terms of the broader picture, it's going to take longer for it to play out and to see how self-sustaining this recovery will be. And I think that it's an issue that does have that extra layer of complexity, because it's easy to just look at China and go, oh, it's the world's second largest economy. It reopening is going to be huge. It's going to boost demand for commodities. And that's true to a degree, but it's about how that demand is going to come on. I mean, for example, we're going to be dealing still with the legacy of COVID over the Lunar New Year, how that's going to hit consumer confidence, how that's going to play out with the Chinese populace as people head home in, what is the largest, internal migration of people in the world. So it's going to be really interesting to just see how all that plays out and how swiftly the Chinese consumer can return to normal, because for example, Chinese retail sales are still, I believe, about 17% below their pre-COVID inflation-adjusted trend. So even just getting the Chinese retail sector back into 2021, peak 2021 levels of consumption is really going to boost demand for commodities on the manufacturing side of things. So I think it's a very complex picture with very differing outlooks for different commodities, depending on how the timeline of all this plays out.
Thank you. Well, I wanted to also go into a little bit on the nat gas situation in Australia, because we've seen kind of the Australian government come down on the nat gas industry lately. What does that mean for exports? And you can kind of tell us what the major export market is for Australia, and how will this affect those countries that are currently imported from Australia?
Well, Australia's major export markets are Korea, Japan, China, but also there's also growing demand because of the issues with Ukraine, with the gas supply. There is growing demand for Australian natural gas from across the world. So you've got, for example, was recently some of the first large shipments delivered to Europe. So there is that impact. And in terms of the issue with the capping of prices, we have seen some of the gas companies say that this is going to impact their capex. It's going to potentially impact the downstream supply of LNG heading into the future. Now, to what degree that ends up being the case in the long term is obviously anyone's guess. Australia is still a quite attractive market to invest in general, and this gas price cap may end up being relatively short-lived, particularly if we do see gas prices moderate as they have recently, because right now, last I checked, the gas prices in Australia are actually below the cap. So it's going to be quite interesting to see how that plays out in the long term, because it's the commodity industry in Australia has a fair bit of firepower. In the past, when governments have tried to impose various different, shall we say, restrictions on their ability to make a living with, say, for example, Kevin Rudd's and Labor's mining tax back in the late 2000s and early 2010s, that fell by the wayside relatively quickly. So I think that there'll be a lot of pressure on the Albanese government politically in the long term for this to be removed and for this distortion to be removed from the market.
Great, thank you. We'll go back to Tony's still not yet ready yet, so we'll move this back to Valina. I wanted to kind of talk about with China reopening, do you see this as obviously they're going to be competing with India for commodities globally. How do you see this affecting India, or do you think that because China's kind of been offline, right, for a while, that India's kind of moved in and established relationships with those suppliers?
That's an excellent question, Tracy. And here I see several mutually interlinked challenges from India's point of view. Now, obviously, India will be eager to shorten costs emerging from the diversification away from Russian energy commodities. It is clear that both China and India will, of course, seek to diversify away from Russian commodities as far as possible in the long term. And given their, well, let's say, bilateral military conflict that, as I said, is going to unfortunately continue, they will need further, let's say, energy commodities partners. And as we also heard from the colleagues, it's pretty tight global market right now. Second important challenge is, of course, how India is going to manage to boost its defense budget, which is clear that it's going to happen. And given once again the dependence over 54% on Russian arms sales, there will be plenty of opportunities for other, of course, major suppliers, arms suppliers. Both China and India are still quite dependent on these arms sales. They have also, for instance, they have also imported, the S-400 air defense system from Russia now, with the military defeats taking place in Ukraine. There is this consideration. There is a major challenge from India's point of view when it comes to Russia's weaponization of interdependency, specifically when it comes to food and energy commodities. And India has been pressing Moscow under closed doors, behind curtains, throughout the last year on specific topics, one being the grain initiative that Turkey and the United States in fact managed to seal with Ukraine and Russia to smooth a little bit the global food markets, and specifically because many countries in the south, in the global south, are dependent on grain exports coming from Russia and from Ukraine. And as I said, there have been a lot of efforts from the global south to actually, get more imports also from India. But India, of course, is very cautious on that matter and is trying, of course, first and foremost to secure the commodities, specifically the food commodities for its own population. So one of the major challenges from India's point of view is the future of commodities price shocks, and they are actually expecting that this is far from over. Of course, the post-COVID-19 implications as well. So in general, here I see a mixed picture. On the one hand, I'm pretty bullish when it comes to the prospects and the outlook, the macroeconomic outlook of India. As I said, the economy is projected to grow. There is going to be a lot of investments coming from the government in specific sectors, and that all is actually screaming more demand for not only fossil fuels, but given the fact that nuclear is still pretty much, and renewables are still more on, on the weak side of the energy mix in the Indian case, I expect that in the short term there will be a lot of demand coming from India. And then again, I'm somehow probably somewhere in between when it comes to the macro outlook, the short-term macro outlook coming from China. following the lockdowns, given the fact that we are still not having the full picture when it comes to the health situation in the country and how long specifically the health system and the government are going to cope with the current situation. So all together, that means that my anticipation for this year is to have a kind of a turbulent relationship. For from China's point of view, there's obviously now also the situation that India has been hugely capitalizing on some of the diversification of global supply chains. Certain supply chains have been partially reconfigured towards India. India is also in the middle of, let's say, these global and regional geopolitical power shifts. Think of the relationship with the United States, the bilateral, but also think of the multilateral formats that are led by the United States in this region. And that means, of course, partners such as Japan, Australia, but also South Korea. And that, of course, will convert into a very positive geo-economic outlook. Think of semiconductors, think of the Internet of Things, with India being actually, and I did not know that, I learned it actually in India last week, that it's having the largest amount of digital transactions in the world. So all of this is projected to grow, and the defense sector, and as I said, the growing demand for commodities, specifically, of course, steel, fossil fuels. We have, on the one hand, rather a very optimistic picture in the case of India, and not so optimistic picture in the case of China, which is why my, so to say, conclusion is that this, of course, will not be well perceived in Beijing. So it is more or less, I mean, this bilateral relationship is more or less destined to further deteriorate. Last point on my side is related to the way how China has been actually projecting more military presence and power in the direct vicinity of India. On the one hand, by engaging with the direct neighbors of New Delhi, mostly, of course, Pakistan, Myanmar, Sri Lanka, but then again also in the Indian Ocean. And that, of course, will pressure India to be more active on the regional but also on the global arena. Here, what I expect is that India will have to boost its regional portfolio with the direct neighbors. We will see more active India in South Asia, but also in Central Asia. We've seen already a new transport corridor that has been a little bit overlooked in the analysis of most of the experts. This is the international North-South transport corridor that passes or goes through Iran, Central Asian countries, and then is linked to Moscow. The idea is that then there is a deviation towards Europe and European markets. But we will see also more active India on the global arena. When it comes to the so-called global south, India is now in the lead of G20 and is more active in the global south, and specifically also African countries. This once again will pressure China. As we know, China has been pursuing this, so to say, global strategy via different economic instruments. And of course, it will mean that China will see itself more pressured not only to engage with various corners of the world because of its competition with the United States, but now increasingly also because of its competition with India.
Thank you very much for that. And we have Tony is up. Has joined us. So appreciate that. So we'll go to Tony. I'm sorry, you kind of missed the conversation, but I kind of want to talk about, I want to talk about China with you, obviously, in particular, because you live there and you're very familiar with it. But first, I want to talk about this zero COVID to abrupt reopening. What do you think caused this drastic change in policy? And also, what are some of the policy uncertainties that we should be looking for in China as far as this reopening story is? Okay, he's here. He was up. Now he's gone. Tony, you there? I just sent you another invite. Hello? You were just up here. Shoot. All right. I love when Twitter glitches. All right, let's go to. I'll go to Vandana really quick. I kind of wanted to talk to you a little bit about Japan, right? And so, we have seen, Japan is one of the largest natural gas importers in the world, right? We just saw Japan's prime minister go take a trip to Canada to secure LNG, which did not work exactly as they planned. But as far as we know they still have a relationship with Russia, but how dire is the situation in Japan right now if they're kind of traveling the world right now to secure natural gas, and is natural gas in such short supply that that it's becoming a fight to secure cargoes?
Yeah, sure. So it's an interesting country. It was, I would think, probably 7, 8 years ago that India actually overtook Japan in its oil demand, and when that happened, it actually surprised quite a few people, including veteran industry watchers, that at the speed or how fast that had happened. And of course, as we all know now, it's all down to demographics, and that demographic dynamic hasn't changed. So exactly what has powered China and India's growth as energy consumers, essentially demographics, is the reason that Japan has plateaued a while ago, and it's actually now for past several years on a very gradual downward decline in terms of overall energy demand. So when you talk of Japan, obviously, I think one of its biggest vulnerabilities is it's nearly 100% dependent on every energy source, you name it. I mean, aside from nuclear, we can talk about that separately, but it produces virtually no oil and no gas, and it has to import all of it. What is going in Japan's favor, oddly enough, it sounds odd to say that way, is that it's not really a growing economy. It's not the population is not growing, so it doesn't have that sort of demographic dynamics that China and India has. So yes, they are still very, very dependent. They will remain for the foreseeable future very dependent on imports of oil and natural gas in the form of LNG. But they are not having to worry about how to procure when your demand is growing 5, 6, 8%, like the kind of worry that China has had in recent years, or that India will presumably have in the coming years. The other huge advantage that Japan has is that it's got paying power, and I mentioned that before, but I think it's important. So in that sense, yes, it sits in Asia, but it's a first world country, and it has that, it can. So let's say if 2023, God forbid, were to see a similar sort of energy crisis, and especially having to pay top dollar for gas and competing with Europe, Japan would still be able to pull in whatever cargoes it needs to pull in, in rivalry with Europe. To some extent, China would also be able to do that, but India, for instance, as I mentioned before, and certainly not countries like Pakistan and Bangladesh. They would be just nowhere able to compete. So Japan, in that sense, yes, it worries because of its near 100% dependency, but it has the paying power. And you touched upon a very important point there, that yes, they have somehow, I think they've been, to some extent, almost like India, they've been a bit pragmatic when it comes to securing their energy needs. So they have, for instance, the likes of Mitsui and Mitsubishi. They went back when Putin, basically the ExxonMobil and Shell and BP walked out, and Putin decided to nationalize the Sakhalin-1 and Sakhalin-2 oil and gas projects. And Kremlin said that, okay, Japanese companies, Indian companies who were in those projects, if you want to remain stakeholders, you're more than welcome to, but you will just simply have to reapply. And Japan did, and so did Indian companies like ONGC Videsh, and they didn't flinch. It was a very clear directive from Tokyo to Mitsui, Mitsubishi, Sudeco, and I think another company, that absolutely go ahead and reapply, and those stakes are important for us, because so it's pragmatism. It's an acknowledgement that yes, while Japan is aligned with the West in against Russia on the Ukraine situation, at the same time it's not going to surrender its energy security in order to do that. And even when it came to the Russia oil price cap, Japan managed to get itself excluded from. So it is able to buy oil from the Sakhalin project without having to adhere to the price cap. So overall, I see a very pragmatic approach. Japan, of course, is also still struggling with how to get back some of its, or reduce its dependence on energy imports by bringing back up its nuclear power capacity. And as we all know, that suffered quite a bit after the Fukushima earthquake, and there came a point when the nuclear capacity was quite low. Power plants were shut down, and there was a lot of public angst and essentially protests against the restart. But I see that the government is now gradually coming back onto that track as well. And maybe that's topic for another time. But I think overall, nuclear energy is sort of perhaps in a renaissance, of going to see a renaissance in parts of the world. There's a power plant in the Philippines built, I believe, 40, 50 years ago, which was built but not operated for a single day. And now the Philippine government is also thinking of bringing it back up. Indonesia is once again thinking of maybe putting up a nuclear power plant as well. So that's it. Basically, I digressed a little bit into nuclear energy, but that's essentially the story of Japan.
Thank you. No, that was a good digression. That was very valuable information as far as nuclear. So Tony is back. He can hear now, and so he probably didn't hear my. I don't know if you heard my question, but I'll restate it. I'll restate it. So, all right. So we have the zero COVID policy in China to like an abrupt reopening. So first, what do you think caused this drastic change of policy? And then I also want to talk about what are some of the policy uncertainties that we should be watching for on China with this kind of reopening, story that is, been very bullish commodities. And then kind of the third part of that is, do you think the markets are being too optimistic right now?
Okay. Yeah, thanks, Tracy. Those are great questions. And I apologize to you and everyone else for being so late today. I had other stuff, other calls going on. So, one of the things that I really don't hear people talking about around kind of the ripping off of the zero COVID Band-Aid is the danger of policy uncertainty in China. That was a very much an abrupt about-face policy change. And what China has really made its name on for the past 30 years is policy certainty. Until Xi Jinping took over for the previous 20 years, you had a pretty good idea that when China made a policy announcement that they would carry through on it, typically in the timing that they would carry through on it. And of course, you had different emergencies like blue ear disease among pigs in 2007, these sorts of things where, it wasn't perfect, but they did pretty well. But with COVID, there has been this ongoing level of uncertainty within the Chinese government. And I think the COVID zero policy about face showed me that they really generally don't have a planning process anymore. Okay. And this is what happens when you have kind of strongman control over a government. So how China became the world's favorite manufacturing location, of course, is low wages and cheap energy. But it's also the ability to rely on Chinese policy execution. Now, I think it was just yesterday, the Hong Kong CEO announced that he said, we're not sure if we'll be able to lift the mask policy in 2023. Okay, so Hong Kong used to be really rock solid, like the policy gold standard for policy execution globally. And what's happened since Beijing has taken over Hong Kong fully is they've really turned Hong Kong policy into a circus. So they've turned literally the most reliable business operating environment in the world into a clown show. Okay. And I think there are a lot of oil bulls right now who are very excited about the China reopening and who are taking China policy announcements at face value when the credibility of China's policy announcements over the past 6-7 years has eroded dramatically. So honestly, you don't know what these guys are saying. You don't know what is going to happen, and you don't know when it's going to happen. So I think we all need to become huge skeptics of China's policy announcements. And we have to take the approach that we'll believe it when we see it. And so for those people who are crude bulls based on China kind of coming back post-COVID, I would, it's great to be excited, but I would be careful and potentially moderate your outlook, because I'm not sure that the central government can execute at the level that they think they can execute. And a lot of that comes from the fact that bureaucrats simply don't trust the politicians. There is a lot of fear within the Chinese bureaucracy, and that fear equates to inaction. And then when there is action, it's coerced action. So, we have what was I would say, a semi-professionally run bureaucracy, although it was fueled by corruption, turning into an ineffective bureaucracy still fueled by corruption. So, and I spent a lot of years going in and out of China. I spent a lot of years advising the Chinese government. I spent a lot of years really close to what was happening there. And what we've seen over the past 12 months, but more broadly, the past probably 6 years, has really made me question the ability of the Chinese government to execute really on anything.
Could I just add a quick footnote to some of Tony's excellent points here, if you don't mind, Tracy?
Of course.
Yeah. So I completely, really great point, Tony. And I'm not sure if you were with us earlier, when Tracy asked me what I thought of how Chinese oil demand might come back this year. And I said, I'm certainly not anywhere in the uber bullish camp. And the point you make there, what I would add to that is, and just elaborate a bit on what I said earlier as well, is that a lot of the excitement that is happening now in the oil market is, just looking at how people are back on the roads, back in the subway trains, measuring those kind of metrics. But again, those are against a very, very sharp dive in mid-December. So it's starting to come back from there, which is not exactly a reason to get so excited that you pile on $6 or $7, $8 per barrel in crude. But I think we could see an initial burst of jet fuel demand. And, here we're easily talking of maybe 250, 300,000 barrels per day, because that has been such a, not just laggard, but it's been suppressed the most because of China's zero COVID policy. So I think some of that excitement is, just seeing how people are, sticking to the skies again within China, and internationally, wanting to, people who've been cut off from not seeing their families in China for years, or, both coming into China and flying out. So I think we will see a lot of that. But the real growth momentum, I think the real test of that will probably be sometime in the second half of this year, which is when all of China's fiscal and monetary stimulus might will have to basically will be put to test on whether it can actually jumpstart the economy. And of course, when it comes to oil demand, it will have to be driven by a pickup in the manufacturing activity and domestic consumption. So, sorry, a longish footnote, but I just wanted to say that.
No, thank you. Thank you very much for that. So, Tony, I want to go back to you really quickly. So all eyes are on the China property sector, right? Especially in the commodities world, because the property sector was booming, and it's not anymore. So can you, for people that are focused on commodities, they are focused on the property sector, and so I mean, do you see this growing, or do you see this? It kind of seems like there's this push to nationalization, right? And they're going to let kind of these public companies kind of go to waste. And if there is some sort of nationalization, is this bullish the commodity sector, or just kind of give us a overview on the property sector in China? That was for you, Tony.
Sorry, Tracy. I heard about. I'm hearing about half the question. I apologize. Can you hear me?
I can hear you fine. The question was about China's property sector, because that's important to commodities.
Yep.
Yeah.
Okay, so generally on the property sector, so the property sector has been fueled by speculation, partly because people on the mainland don't have a lot of places to invest. Okay, you have a market, you have banks that give you a set percent, and there are not a lot of investment options. So property is a speculative investment, and you can only have so many second and third homes that you rent out. And we have a declining population, and we don't really have immigration. And the immigration that China had, say, pre-COVID, has come to a halt. And this was kind of largely expats and other people, but a lot of that stuff has come to a halt and will decline, because a lot of expats are freaked out about being on the mainland and they're moving to Singapore. So I would say I'm not particularly optimistic about the property sector in China. I'm not particularly optimistic about new builds in China. We may see a period where we have destruction of property in China simply to reduce the supply. It will come back. Property is cyclical, and there is a replacement rate. But I think with the declining population and with limited opportunities and limited immigration, I think those opportunities are at least in the short term kind of capped. So I'm not quite sure where that super bullish upside is, but I'm not seeing a huge impetus for massive growth in the Chinese property sector, aside from just relief and containment, which is just bringing things to a baseline valuation.
Great. Do you see a push towards nationalization or not? Because there's some rather strange headlines coming out of China lately.
Well, whether or not it's explicit nationalization, I think it could be, at least to some extent, financial nationalization, because these property companies simply can't make it on their own. So, what's the difference between the Japanese government owning the ETF market or making direct investments in the equities of Japanese companies, and the Chinese government doing the same through the public equities market or through loans or something like that? It's just kind of a financial nationalization of selective markets. So I don't see that as a remote possibility. I see that as a very likely possibility.
All right, thank you. And I'll go back to Tarek, and then we'll do a round of final comments because we're hitting over an hour, and I know everybody's tired over in Asia right now. So I kind of wanted to talk a little bit about Australia's trade with India. Is that growing? Is that a growing market that Australia is specifically targeting? And, is that a more reliable partner than China, say, at this point, just because of the history between those two?
I would definitely say that India is seen as a more reliable partner than China. It's long been seen as as a country defined by the rule of law and a similar judicial system. So trade is seen as a lot more safe when you're doing it with India than when you're doing it with China. Also, I think there's also just the fact that India is expected to behave as shall we say, a more rational actor that isn't going to take these punitive measures that China has against Australia. And I think it's also just the fact that as the demographics of Australia shift, as a larger and larger proportion of the population are migrants from India, that you are seeing that political shift towards a more warm relationship with New Delhi, and just an improvement of bilateral ties. You're seeing that also with as Valina mentioned earlier, with the Quad, with the Australia, India, Japan, and the US aligning themselves in a bit of a geopolitical pact. But just to go back to something that Tony was saying about the Chinese property sector, I think it's a really interesting dynamic there, because according to an interesting study from, I believe it was Kenneth Rogoff, that was written in 2018, something like over 80% of Chinese new property, was bought by people who owned one or more homes already. So it's very, very much a speculative market. And until they find a way to make the Chinese people believe that it is a good investment, that it is something that's going to go up in value, there isn't really a whole lot of reason for the Chinese public to get back into that particular market. And the headlines that are coming out of China from the Chinese government aren't really that encouraging on that front either, because they keep talking about the stabilization of prices, rather than a return to the sort of pre three red lines, pre-COVID status quo of just quietly pumping the market. And just one other small little piece that I'll try and sneak in here is that special government bond issuance in China, which is basically done by local government to fund overwhelmingly infrastructure, is actually going to be about 400 billion yuan less in 2023 than it was in 2022, and it's likely to be a lot less front-loaded than it was in 2022. So it's going to be really interesting to see how commodity demand gets balanced in that regard, in terms of those bulk commodities that do go into construction, whether we'll actually see this big uptick in demand in reality that the market is expecting and is really in a lot of ways starting to price in.
So in your opinion, do you think markets are, we've seen a big rally in a lot of, particularly the metals and base and industrial metals. Do you think that the markets are being too optimistic at this point and we see a pullback, or do you think this is a justified move?
I think it depends on the metal in question. I think something like copper, with its low levels of inventory, with increasing demand coming from around the world, that move is very much justified, and I'm quite bullish on copper's prospects in the long term. Even if we do see a global recession or a major slowdown in the latter part of this year, that copper's future is quite bright. But when you're looking at something, say, like iron ore, where you're seeing, intervention in the market, you're seeing, Beijing trying to suppress prices, trying to get central control over pricing power, over deal making, and also just the fact that it is well and truly an overwhelming China import relative to all these other commodities where they're imported from all over, where the demand base is a lot larger. China is by far the largest. It imports more iron ore than the rest of the world combined, and then some. And I think we may be getting ahead of ourselves in that regard, because if this upsurge in demand, this recovery in the property sector, in construction more broadly, doesn't eventuate, I think that the market could be getting ahead of itself. However, I'm not sure that that's going to matter to the market anytime soon, because right now it just seems, for want of a better expression, just drunk on the idea of Chinese stimulus, of the Chinese reopening, and how that all fits into this global Goldilocks situation that a lot of people are hoping for.
Absolutely wonderful points that you made. So now I kind of want to go around and get everybody's kind of closing thoughts, or discuss something that you want to discuss that we haven't been able to cover at this point. And we'll start with Delina.
Thank you, Tracy. Some final remarks on my side regarding India, what may be interesting for our listeners. It's interesting that India and China are aligned very much in terms of their positions on Russia. For instance, for both the potential use of nukes against Ukraine is an absolute red line, even though that India has not announced this officially. But I can assure you from my talks with representatives that they definitely share China's view. China has been vocal on that matter, and I think this is a good news in terms of expectations and anticipations of major geopolitical shifts in 2023. Second important point that I think is interesting to share is that India's view is not aligned with the American one when it comes to the anticipation of military attack by China on Taiwan. India still regards that the higher risk, geopolitical risk, will be linked to deteriorating humanitarian situation in South Asia, terrorism emerging out of the political vacuum in Afghanistan, but also, of course, directly linked to Pakistan. And as I said, they actually regard the risk of direct military tension with China along the line of actual control as higher than the short-term risk coming from a potential military attack by China on Taiwan, which I think is also good news to share, given their experience in that matter. And then, of course, there are certain views regarding the the ongoing systemic competition between United States and China. Obviously, India will be eager to prevent the emergence of any, let's say, binary world or Cold War 2.0 scenario. India does not want to strategically align with a certain bloc. So any kind of bloc building between China and United States is actually not is detrimental to the Indian interests. And in case, let's assume that the coupling and systemic competition will continue. I certainly, and this is my personal assessment, anticipate that India once again is going to be kind of oscillate between, on the one hand, China and Russia, and on the other hand, United States and other valuable partners, such as the ones that we have been covering today. So it's going to be very interesting to observe. Contrary to what Tony has been highlighting in regards to China, the numbers speak a very different language in the case of India. Extremely positive demographics, a huge share of labor force, which of course will be linked to rising demand in all sectors and domains. And given the fact that India has quite of a political predictability right now when it comes to the government and when it comes to, let's say, governmental stability, and a government that certainly will be eager to further invest and to meet the needs of its population. This is all screaming actually to be bullish in terms of all these relevant sectors. The nexus between food, air, water, and all the relevant, of course, commodities is going to be critical from India's point of view. And as we've already covered at the beginning, in the Indian case, there will be a certain goal to diversify away from a single supplier when it comes to fossil fuels. But India's story is definitely going to continue in terms of the use of fossil fuels. The geological aspects of the country are in fact challenging for the home extraction of fossil fuels, so it will be dependent on imports. And yet, to diversify away from certain dependencies, India will also seek to invest a lot in the green sectors and in the renewables. Alone, the share of electric vehicles has skyrocketed in just 2-3 years because, like I said, because of demographics. So it's interesting to observe and to assess this contrast between China and India in this particular year. A lot will depend on external variables in terms of how they will react to certain changes and shifts. We don't know exactly the outcome of Russia's war against Ukraine. Nobody knows, of course. And then again, we don't know exactly how this bilateral competition between United States and China is going to evolve. Final point on my side, because I think this is once again quite bullish for the commodity side, is the fact that India is absolutely eager to get interconnected with the global supply chains. India wants to become part of global supply chains. Of course, here the main idea is those that are under, let's say, American facilitation and control for the sake of security and stability. But this, of course, once again points to a quite optimistic picture for this year and for the next ones. Thank you.
All excellent points. You know, and I think population demographics was a very interesting point because as we see, India is a much younger population, whereas, you know, China is a much older population and declining. So if you're looking over the the macro view long term. All your points about India make absolute sense. So we'll move to Vandana. Same question. Is there anything that we didn't cover that you wanted to cover, or your final thoughts?
Yeah, thanks, Tracy. So I would like to close on a note of caution. Talking of the energy markets, I think a very clear risk hiding in plain sight is another super cycle. While we were debating over a recession, what extent of recession, or at least a global economic downturn this year, I think the one relief factor, or silver lining, if you will, in that for a lot of countries, especially that suffered greatly from last year's high energy prices, was that at least energy prices will come down. That'll help inflation come down as well. Now, of course, we started the year on a bleak mood. Crude was under a great deal of pressure. That seems to have changed quite dramatically over the past week and a half. I was reading positive comments made at the World Economic Forum in Davos. I believe the IMF deputy managing director said she expects to upgrade 2023 economic outlook, and so there's been quite a bit of cheer over perhaps soft landing in the U.S. And I know there's been this whole Fed pivot optimism that's been going on in parallel as well. Now, all of that is good. I'm sure it makes all of us happy, relieved even if we can avoid a severe global recession. But the danger for the energy markets is that if Chinese economy rebounds, oil demand rebounds, and the rest of the world's oil consumption does not erode to the extent one might have expected in a more severe economic downturn, we are going to face another very severe supply crunch situation, whether it's oil, whether it's gas. It's going to be exacerbated by this huge global trade realignment shift. At least not one that doesn't parallel match anything that I've seen in my years of watching the energy markets that's happening because of the sanctions against Russia. And you have obviously upstream investment continues to spiral down. That's not going to change. Of course, there's a lot of environmental pressures playing into that. And OPEC plus, at its worst last year, now nobody's talking of that, of course, because the focus is on demand, not supply, but at its worst last year, it was pumping 3.6 million barrels per day below their target. Since they reduced their target since last November, obviously that has now they are pumping 1.8 million barrels per day below the target. But the fact remains that the vast majority of OPEC Plus members are struggling to bring their production back to the levels that they were pumping happily until April 2020, when they introduced major cutbacks. So basically, below ground reasons, above ground reasons, a lot of the countries are probably past their peak production. Global oil majors are not investing. So, what happens of course, we all wish that the global economy survives, it doesn't meet its worst fate this year. But, 2020, if not 23, 24, it's just waiting around the corner. So, get ready for another energy super cycle.
Thank you. Tart, same question.
Yeah, I think that Vandana makes a really good point about the issues of capex and the ability for supply to keep up with demand, and I think that's true in quite a lot of commodities across the board, particularly as we see this push towards green energy. I mean, in the lithium space, even in more traditional minerals like copper, but I think one thing that's really interesting in the commodity market at the moment is just how things have changed since 2020, and even just more recently since the war in Ukraine began, because it's forced nations to reassess their situation and reassess how they get their supplies, what levels of stockpiles are necessary, and what they need in terms of reserves in order to be able to insulate themselves to a degree from these types of price shocks. And I think that's an interesting point that Valina made earlier about India. I think that's going to be a real key theme for not only 2023 but just going forward as nations just try to for a start, they become more involved in the acquisition of commodities, in ensuring their supplies, and I think that's going to be a really key bullish factor for the commodity market more broadly going forward, just because there is those supply imbalances, and there is also that growing geopolitical uncertainty that things could go bad, that there needs to be a preparation for the supplies to be potentially interrupted or even cut off in the short term for any number of geopolitical reasons that I think Valina covered quite well during this Twitter Spaces. So yeah, I think that there's quite a lot of factors that are, shall we say, cyclically and structurally bullish for commodities.
Thank you, Tony. Your closing thoughts.
Great, thanks, guys, and thanks for letting me participate here. I really appreciate it. I'm going to keep it quick. So, I spent most of my adult life in Asia, and one of the things I miss about being in Asia, and most people who live there would hate this, but there is volatility every single day in Asia, right? I mean, in the US or in Europe, if you miss an economic print by 10 or 20 basis points, it moves markets. In Asia, you could miss by 50 and it's just not a big deal. And so, when we talk about things like what will China's economic output, or what will their consumption, or what will their air travel look like in China this year, I think there's a wide cone of expectation. And so I really do think that places like China, they will make their economic number statistically, whether they do, in fact. But I think what they don't want to happen is huge jumps either way. Okay, so I do think there are opportunities in commodity markets based on investor expectations, really more than anything else. So I do agree with Valina that India really wants to be that key supply chain spoke. I don't think India's ready. I mean, anybody who knows me knows that I'm a huge India fan, but doing business on the ground in India is very different from what government plans or what kind of hypotheticals about India as a part of a supply chain say. So it would require a huge amount of management still, and a large investment to get things moving in India very, very quickly from a manufacturing point. So in terms of energy consumption related to, say, supply chains in India, I'm not sure this is really the year that stuff would start. So I think in general, Asia is going to do fine this year, but I don't necessarily think it's going to be a stellar year. I think we will see volatility more based on misplaced expectations rather than misplaced misplaced investor expectations rather than misplaced planning from the government sides.
All right. Well, and that, I want to thank all my guests. I feel like we covered so much, but yet we didn't even scratch the surface. So I would like to invite all of my guests today to come back at a future date. I really appreciate all of you taking the time out of your schedules for this space. I'm sure our viewers do too as well. Please follow at Place Your Trades on Twitter so that you can see upcoming spaces. And also go to placeyourtrades.com. You can sign up for my blog for free. And then I will see you guys all next Wednesday. Have a great week, everyone. Again, thank you to my guest speakers. It's been a pleasure, and I appreciate all of the wealth of knowledge you shared here today. Thank you.
Thank you.
Thank you. Thank you, Tracy.
Thanks for having us, Tracy.